We have an awesome powerhouse crew tonight for the economics panel. We do this event every month. We either do economics or we talk about some specific investment. If we have not met yet, my name is Bronson Hill. I'm the CEO of Bronson Equity. We are a private equity firm, investment firm that does multifamily investing as well as ATM machines, car washes, oil and gas, and other alternative investments. We created this event just to really try to create valuable conversations. We were talking before that a lot of times you can listen to individuals like people on this panel and they have incredible material, but when you get them together in a room and you have conversations about what's happening right now in the economy, stuff comes out and we all learn from it. And you just being able to be in the crowd and ask questions is a real valuable thing. So really excited to be here. I'm going to go ahead and do some introductions. We'll jump right in. So we have joining us, we have Joe Brown from Heresy Financial. Welcome, Joe. So we have a similar haircut there. So you're a cool guy by that, just by that alone. Joseph Wang from Monetary Macro, former trader at the Federal Reserve. Welcome, Joseph. And we've also got Bridger Pennington of the Ugly Unicorn Fund. It's a crypto hedge fund as well as Fund Launch Live. Welcome, Bridger. Awesome. Looks like you're on mute there. Awesome. Well, good to have each of you here today. We're going to jump right into it. And really the purpose of this economic panel is there's a lot of stuff happening. And a lot of people would say, you know, are we in a recession? Are we actually in a boom? What's actually happening? There's a lot of kind of schizophrenic things. You know, rates are rising. So if you're an investor, a lot of folks are investors trying to figure out, what do I do with my money? Inflation, is it 6%? Is it 15%? There's a lot of misdirect around this. But let's talk for a minute, just kind of what are you seeing happening right now in the economy? Are we, in a recession? What's the best way? I know it's hard to look at something in the moment and say, this is exactly where we were. Usually we kind of look back and see where we were, but what do you see happening right now, kind of on a macro level in the economy? Maybe we can start with Joe on this one. Joe Brown.
Yeah, I mean, number one, we have to take a look at the money supply, in my opinion. And so we saw the money supply expand rapidly in 2020, and then the whole slew of effects that followed that, with prices going up, supply chains, there are a bunch of unintended consequences, and then many people, I mean, for 6 months at least, the Federal Reserve was communicating to the economy, hey, we're going to start tightening at some point. And literally the only thing anybody said, and me too, was they'll never be able to do it. They'll never be able to raise rates. They'll never be able to shrink their balance sheet. They'll say they're going to try, they'll pause, maybe they're easing, and then they'll have to reverse course. That was kind of the biggest shock, I think, to the markets for a long time, was number one, that they did it, and then that they continued to do it. And the whole narrative since then has been, when are they going to stop? When are they going to stop raising rates? And so now that's the big thing that the market is looking at, is when are they going to stop raising rates? Because obviously they paused this last time, but they're still communicating, hey, we're going to do, maybe one, maybe two more, just maybe not at every single meeting. We're just looking at the inflation data. Meanwhile, there's a lot of lagging effects from all this, which is why I think they tend to take their time on some of these moves. But take, for example, like the money supply, it is shrinking at the fastest pace since the Great Depression. And so the effects of that have not yet been fully felt by the economy, just like the inflation that happened was a full year after the money printing started. And so it takes time for monetary policy to hit the economy. And so I think that's the next thing that the market is really not anticipating, is the effects of the actual shrinking of the money supply. And so we may even see some deflation hit, depending on what the response to lower inflation numbers is.
Yeah, that's a great point, Joe. There's a lot of uncertainty around there. Bridger, what are you seeing? What are some things, particularly kind of in your area in relation? I mean, anything touching crypto, or just when you're looking at the economy, how are you evaluating things now?
Yeah, I think Joe hit a lot of great things. I'll add on to that. So I have about 60,000 entrepreneurs in our group of community. We've seen across the board, I've talked to a lot of them that run businesses outside the financial service spaces. And a lot are saying revenues are down 30 to 40% this year. I've got family members who run businesses. If you even look at NVIDIA just hit their huge market cap. If you look at their gaming computer chip division, down 35% revenue this year. Most companies we're seeing is that's the case. Even these high growth companies that maybe they should have been here, they're marked down. It's interesting as well to see evaluations from venture capital backed firms. I believe a lot of secondaries are trading, at least in my space. I work with a lot of venture capital funds. They're saying around 50 to 60% discount off of the previous round is where secondaries are currently trading. And so a lot of funds and companies expecting down rounds. I was talking to a friend yesterday. I'm like, I feel like the recession is here and hitting businesses across the board. When the Fed raises rates, they want, at least my rule of investing is don't fight the Fed, don't fight the Fed, don't fight the Fed. And the Fed is raising rates. They want to contract an economy. They don't want to do quantitative tightening. So don't fight the Fed when you are investing. And they want to do this until they break something. We've seen a few banks break already. And Jerome Powell's come up and said, hey, we're still seeing, the data that says we're going to at least keep rates where they're at, if not raise them twice before the end of the year. I believe they're going to keep rates or continue to raise rates on their schedule until things continue to break. I believe war chests are starting to run out. Most companies have a war chest. They wait for times like this, and we will see whose war chest runs out and maybe is running out right now, that will be headline news in 3 weeks or 6 weeks or 12 weeks from now, that their war chest is running out right now. And because of just the amount of adjustable rate loans across our economy is staggering. And so they're catching up with people right now.
Yeah, I know we're seeing that a lot in the commercial real estate space as well. And we do primarily multifamily, but the deals that were cash flowing well were primarily in Florida and Georgia and it's kind of southeast areas. But we're seeing insurance costs go up, costs of labor, materials go up substantially. And then of course, interest costs have gone up a bit, even if you have caps on your interest rates. But they're saying there's a huge bomb with office space that a lot of groups are not paying. And there's a lot of stuff, like you're saying, something is breaking and they're waiting for a bigger break for things to move. Joseph, tell us your opinion. I know you wrote this great book, Central Banking 101, helped me to understand the central banking system, particularly in the US. What are you seeing right now in the economy?
Yeah, well, first of all, thanks so much for inviting me. And also it's great to see you again, Joe, and it's great to meet you, Bijur. So, I'm going to piggyback off on what both of them mentioned. Well, first off, let's rewind back, let's say 2 years ago. 2 years ago, inflation was high. The Fed was going to hike rates. The Fed was telling you they're going to hike rates maybe a lot. And no one believed them, like Joe mentioned. Everyone was like, no way, the Fed can't hike rates. If they hike rates, the entire world will implode. I mean, look at the debt burden, right? If we go to 3-4%, the economy can't handle it. The markets can't handle it, and everything would melt down and we'll all be living in caves. And fast forward to where we are today, we hiked rates to 5%, right? 5%. And when we look around, it seems like it didn't really do that much. Now, overall, there are pockets where it has caused stress, but overall, let's think about this. The Fed was hiking rates last year. Everyone was freaking out. Equity markets sold off a lot. Bond markets were selling off as rates were going higher. Now, today, it looks like the stock market only goes up. And if you look at some really interest rate sensitive sectors of the economy, like housing, well, people were saying that if we had 7% mortgages, the housing would implode. We'd have another financial crisis like in 2008. But when you look at the data, it looks like single family homes, they were dipping last year, seemed to have bottomed out earlier in the year. And the most recent data suggests that in many parts of the country, they're actually rising again. If you look at home builder prices, for example, home builder stock soaring towards all-time highs. It's like a tremendous boom. So Fed hike rates to 5%, and it seems like it didn't have as much impact as many people thought would happen. I mean, look at unemployment, for example. Unemployment rate still at multi-decade lows. Every month, we're creating a lot of jobs, wages growing at 5% year over year. So much higher than what was happening pre-COVID. If you look at all this data, it's hard for me to think that the economy is not doing that well. Now, to be clear, there are certain segments of the economy that are super interest rate sensitive and that benefited a lot during the COVID view who aren't doing as well. VC, for example, and spaces in crypto, as Richard mentioned, are not doing as well. And of course, Bronson, and as you well know, there are pockets of commercial real estate who are not doing well as well. But if you zoom out and look at the overall economy, overall, it seems to be okay. And that's part of the reason why inflation, as measured by the Fed's favorite measure of inflation, core PCE, is still between 4 and 5%, even after 5% rates. Now, there are people in the Fed who say that monetary policy, it takes time to work through. So eventually this 5% interest rates will slow down. So, that could happen, but there are also people on the Fed who think that, this is not behaving the way that I thought it would behave. Maybe what's really happening is that interest rates are not as effective as we thought, and we might have to keep hiking rates. And so I think that's what they're going to do, simply because what things have not worked as well as they thought. Now, let's hold that thought for a moment and we can zoom out a bit. So this problem of high inflation is not unique to the US. It's something we see all over the world, in the Eurozone, in Canada, in Australia, basically all the Western countries that look a lot like the US. And they, just like the Fed, hiked rates aggressively, thought that it would work, realized that it didn't, and began rehiking again. So what I'm seeing so far is that the US economy was super strong for the past 2 years. It's slowing, but it's not slowing as quickly as the Fed would like. And so they're going to keep hiking rates. And I think, though, as Bijir mentioned, you should not fight the Fed. Don't fight the Fed. But the market has been fighting the Fed for the past year. The market has always been assuming that the Fed would just cut rates very soon, even though the Fed persistently said that they would not. And now I think what's happening is the market is gradually realizing that the Fed is serious. And so we may now see more of an impact on those interest rates feeding through, simply because rates will reprice higher going forward.
Yeah, that's a really great point, Joseph. It's interesting that, the Fed, I remember this was, about a year and a half ago, they had said, oh, we're keeping rates low. And then I think it was March of 22, they started hiking rates. And it was a very quick switch, right? It was like they just all of a sudden switched. And we kind of, it seems to me the last 10, 15 years, we've gone from having kind of, a boom, and then we have a recession, whatever, to kind of like it's crisis and then stimulus, or like it kind of goes this back and forth. I love to hear, and Bridger alluded to this as well, is that we're going to keep going until something breaks. What do you think that thing is that will happen? Do you think that there will be a break? And what will it be? And will it cause the Fed to pivot when that happens? Let's start with Joe on that one.
That's a good question. So one of the things that obviously that happened recently was the banking crisis. Silicon Valley Bank. Nobody really expected something like that to happen, and then once it happened, you start to look at the data and you're like, oh yeah, obviously, we should have expected something like this. Banks loaded up when rates were at literally all-time lows. Now rates are high. If somebody starts taking money out, it's like lights out. Everything's underwater. And so now they've contained that risk. One of the things that's this is a longer term view. If you take a look at, there's this old saying, do not underestimate the day of small beginnings. And so when you look at Warren Buffett's first investments, tiny, but the compounding results of that are what have turned him into, at one point, the wealthiest man alive, just from the compounding interest of those investments. And that's everywhere. And so when you look at, let's say like the original, the Fed put, the Greenspan put, is just a little tiny thing, just lower interest rates, just soften the blow on the economy. And if that would have been the only thing that ever happened, I bet you nobody would talk about, Greenspan today. Nobody would remember him. It would have just been, something that happened in history. But that set precedence for, it sowed the seeds for a little bit of a larger crisis that happened later on, lower interest rates. So money flooded into housing. And then there was a bigger crisis next time as a result. But now there's precedence for trying to save and stop that. And then, it just slowly rolls and gets bigger and bigger and bigger. And so you have this kind of roller coaster of, something bad happens, so we rescue it. But when we rescue it, that makes things easier for everything else. It spills over and sows the seeds for a larger crisis that then we have to, rescue again. And we continually, have this flip-flop back and forth. So I don't know if there's anything that's happening like right now that's like a short-term risk. But one of the main risks that is definitely there long-term is the government's ability to afford it, its debt. I mean, we're at all-time record highs, $32 trillion worth of debt. The deficits are uncontrollable. And interest rates are, 5 times higher than they were just 2 years ago, and all this debt they're going to have to refinance like half the national debt within the next couple of years because it's maturing, and it's at 5% interest rates. And so that alone is going to make the interest portion of the debt the largest line item on the budget very soon here. It's already just about equal to defense, and that's only growing. Like, even if they stop spending more on everything else, that portion will continue to grow just with interest rates where they are. And so that's a snake eating itself by the tail right now, even if you don't add more fuel to that fire. And so that is a real long-term problem that it could very well get to the point within the next couple of years where the government goes to borrow money and the market just says, well, we don't have any more money to lend you. How about 10%? We'll lend at 10%. And the government's like, well, we can't afford that. We'd have to borrow more to be able to afford that. And, kind of like a stalemate between the government and the market there, with, government debt basically going no bid. And so in that case, the Federal Reserve would absolutely have to step in. They recently, this is last note here, that Powell in the last press conference said, he was asked directly about this. He said, fiscal situation getting much worse. Would the Federal Reserve ever step in and finance government's debt? He said, absolutely not, under no circumstances. So I don't know whether that was saying directly, because obviously it's illegal to directly finance the federal government's expenses, or whether he was saying, no, we're not going to participate in more quantitative easing like we have in the past to soften the blow. But if that's the case and the Federal Reserve doesn't step in, I would very easily see a rewriting of the Federal Reserve Act, folding the Fed underneath the Treasury, something to take command of that, because the federal government's not just going to allow themselves to go bankrupt. But that is a big risk long term that we don't know how it's going to play out.
Right. So they'll find a way to make it work, whether it's changing the laws to make it work for sure.
Can I make a comment on that, the government debt?
Yeah.
I love that, Joe. I think you said that great. I have a contrarian view a little bit on government debt, and I'll spell a little story here. And actually, I would love to hear your guys' maybe rebuttals on this. I'll give reference to my dad is actually the co-founder of, they manage about $48 billion family of real estate funds, top 5 real estate fund in the world. So we get a pretty unique view with our family. My brother's an investment funds attorney at some major funds as well. And so we get a pretty unique view of at least markets in the Fed. And I'd love to hear you guys' rebuttal, but his thoughts, and I've adopted, is the Fed's number one job. They talk about inflation, they talk about job growth, but their number one job is to protect the US's greatest export of all time, which is US dollars. US dollars is the greatest export in the history of the world. We print trillions of them, and people work 60 hours a week. They lie, cheat, steal, whatever to get more dollars. And we print another trillion and they go get more dollars. And since the Bretton Woods Agreement in 1947, we essentially said we will pay for a navy, which is very expensive, to police the entire world, to open up trade routes. And the only thing you have to do, countries, after World War II is just use our dollar. And we became the world reserve currency. You guys know that whole history till today. What's interesting is you have to create demand for your product. So what's interesting is December 2019, we had 2018 going into 2019, great economy's booming, low unemployment. And the Fed comes out and says, we're going to raise rates 3 times in 2019. And they say, great. And they have their meeting. And 45 days later, they change course. This is this is pre-COVID, by the way, 2019. They say, whoops, we made a mistake. We actually are going to lower rates 3 times in 2019, which I thought was pretty interesting. They completely reversed their policy about 45 days later. And then I read a report that there is around $18 trillion trading at 0 or negative interest rates. Now, before that, I know I've studied economics. I've never read a book, a paragraph, or anything about what a negative interest rate is. Yet there is tens of trillions trading at 0 negative rates, which is a whole conversation itself. And so you look at that, and then as of last year, a lot of people have been pointing to the dollar is dead, and Saudi Arabia is considering trading oil, not using US dollars. You have the BRICS nations trying to compete for world, and UN trying to compete for world reserve currency status. Now, if you're the world reserve currency, which is pretty interesting. So you go back just about a year ago, President Biden hopped on a plane and flew to Saudi Arabia to meet with Saudi Arabia, because they were considering not using US dollars anymore. And by the way, we need demand for dollars. Since Bretton Woods, if you trade oil anywhere around the world, if France is buying oil from Saudi Arabia, they cannot use euros, whatever currency you want to use. They have to use US dollars to make large oil transactions. There's only two people in history that I know that have made actually three now, that have made large oil transactions not using the US dollar. The first one was Umar Gaddafi. The second one was Saddam Hussein. And both of them kind of ended up dead from the United States military after they did that. The third one is Vladimir Putin. And right now we're kind of playing a pseudo war with Russia right now through Ukraine for that. It's a big deal if you don't trade oil using US dollars. So anyways, President Biden about a year ago flies to Saudi Arabia. We parked 2 aircraft carriers outside Taiwan to protect Taiwan. Anyways, whole world conflict. And Saudi Arabia says, well, you know what? We're going to keep using US dollars and trading US dollars in oil. Additionally, when President Biden came into office, we were energy independent from Trump. President Biden cancels the Keystone Pipeline. And I was personally perplexed by this. Why would you cancel the Keystone Pipeline? It's oil from North America. It's going to be great. Will be oil so cheap. And what happens is he cancels the Keystone Pipeline and oil prices almost triple since then. Now, again, getting into theory a little bit, potentially, if the United States is energy independent on oil, well, we don't need to buy oil from Saudi Arabia. And if we don't need to buy oil from Saudi Arabia says, well, we don't need to use your dollar anymore. And we say, well, we protect you. Maybe President Biden, I don't know what he said in his conversation, but he said, hey, we house 5,000 troops in the area to protect you. We have an aircraft carrier off your port that protects Saudi Arabia from Iran and other enemies that want to destroy Saudi Arabia. If you don't want to use our dollar, how can I justify to Congress to pay for protecting you to do this? Because we need demand for our dollars. Because we can keep printing trillions of them and people still want them. And sorry, this is all going to make a point here, but this is over the last year. Saudi Arabia continues to use US dollars. If you actually look at the dollar index, right now we have record high inflation, right? Or top record high inflation. The US dollar is up compared to other currencies. People on Twitter love to talk about the dollar's dead, it's going away. They read Ray Dalio's book once and they say, oh, it's world reserve currency is changing. Okay. You know, China went from 1.4% to about 4% global usage, okay, in about 20 years. The US is about 70% right now. The US dollar is up over the last 12 months in the dollar index against all other currencies. So I know some people don't like the US dollar, but it's compared to what, right? I know you don't like it, but you can't just not like something that's compared to what? Compared to euros, we're doing pretty good. Compared to yuan, we're doing pretty good. Compared to Bitcoins, we're doing pretty good, right? And so if you take that perspective with the Fed and where they're at, and especially back to debt, to talk about Joe's point, people, man, I can't believe we're $20 trillion, $30 trillion, $40 trillion, these debt payments. If you were the world reserve currency back to 2019, I believe they lowered rates to have competing debt with the rest of the world. You don't want countries to take out debt in Bitcoins or in yuan or euros. You want them taking debt out in your currency, US dollars. If China holds $1 trillion of debt, not denominated in yuan, it's not denominated in Bitcoins, it's not denominated in euros, it's denominated in US dollars. If they tank the US dollar, they essentially lose $1 trillion off their balance sheet. So if you flood the world with cheap debt that's denominated in your currency, those payments have to be made back and forth, guess what, in your currency. And so it creates insatiable demand for US dollars. As I study the Fed, and I'd love to hear from Joseph and Joe, who's in Bronson, you guys are all very smart in this. I'm curious your thoughts, but when I look back to every move the Fed and the White House has made over the last, let's call it 5 years, it looks like it points back to we need to create insatiable demand for US dollars. And if people don't want to play by our game, well, we're going to put trade embargoes on them. We're going to blow up Keystone Pipeline. We're going to do stuff that makes sure we have insatiable demand for our dollars. We're going to print. Anyways, I'll end there, but that's how I kind of point back. So right now with raising rates, the dollar is still very strong in my opinion.
It brings up a lot too about the euro dollar system, that so many dollars are created by European banks lending outside of the US. Even there's a lot created there. I want to hear from Joseph Wang. Why don't you give us your thoughts on what Bridger said, as well as what, just what we could break in the financial system. I'd love to hear some thoughts in regards to all that.
Well, first of all, I totally agree with Joe that the fiscal situation is totally unsustainable. Now, I'll add some background to that. So according to official projections based on current law, the fiscal deficit is going to be between $1.5 to $2 trillion every year forever. Now, that's based on current law, but as we all know, eventually we're going to have new spending packages, so that number is going to go up. Now, for some more context, 20, 30 years ago, Sometimes we would even have fiscal surpluses. That is to say that we took in more in taxes than we spent out. And that's because back then in Congress, you had a lot of people who took this budget stuff really seriously. They wanted to have a balanced budget. But those people are all gone now. The only way anybody can win an election is by basically paying people with other people's money. And that could be stimmy checks or social services to the general public, or it could be government contracts or lower taxes to big corporations. And so since that's everyone's platform, we can only spend even more money. Now, I'll add something else to Joe's point in that this is really inflationary, especially as interest rates go higher, because who's the largest borrower in the entire country? It's the federal government. So when you raise interest rates, you're basically raising the interest rates of the largest borrower in the entire country. That means they have to borrow even more to pay interest rates, right? So issuing more treasury securities, that's basically like printing a form of money. So it's pretty inflationary, and it's going to make the Fed's job a lot more difficult. Now, I also think that the US dollar is a great privilege that the world uses it. So one of the reasons why the US can go and, issue a whole bunch of debt and, not think too much about it is because, as Bishar mentioned, there's a lot of demand for dollars. People think that treasuries, dollars are safe assets. They're very useful. There's kind of like this huge network effect in the world where globally about half of trade is settled in US dollars. So there's this big network effect, kind of like Visa card or MasterCard. So if you get a credit card, what do you want to get? No, you want to get a Visa card or a MasterCard because it's accepted everywhere. Now, Discover, Amex, those are all really nice networks, but they're really not as widely accepted. And so that limits their appeal. The dollar is widely accepted throughout the entire world. So there's a lot of appeal to using it. And that's a great privilege for the US. Now, I hope that we are doing everything we can to make sure that that privilege persists, and I'm sure that we are, but I think we're also doing some things that are kind of making people think twice about using the dollar. For example, back during the Ukraine invasion, we froze the dollar assets of Russia. Now, if you are another country, let's say a big country in East Asia that holds a lot of dollars, you might be looking at that and thinking, gosh, I have all these dollars, but one day if the US government doesn't like me, they'll just freeze them. Now that's a huge risk, right? Would you want to put your money in a bank where the bank, if they don't like you, will just say you can't access your account anymore? You obviously don't want to do that. That's really dangerous. So there are things like that happening that are also pushing against the use of the dollar. And so you can hear people like people in Brazil, President Lula talking about, hey guys, let's go and have our own currency or currency block. Or you can hear people in Russia or China saying, hey, why don't we try to settle stuff in our currencies? So there's also this movement by smaller countries to try to get around the dollar, but they've not been very successful so far because the US is still doing a lot of things right. And hopefully they'll continue to do that, but I don't know if I don't know if the policymakers we have are up to the task. Now, about what will eventually break, I look at that and I think that's definitely how things played out over the past few years. But this time might be different. And I say that because so far it actually has been different. Now, let's look at the UK, for example. They were hiking rates last year pretty aggressively. And suddenly, if you look at their bond market, UK bonds are called gilts. It totally imploded in Q4 last year. You saw their yields just go kind of spike uncontrollably. And what did they do? Well, they went and did QE, right, to try to stabilize the markets. But after they did QE, after the market stabilized, they went right back and started hiking rates again. Now, what did the Fed do when we had some panic in the banking sector in March? Well, they rolled out this new facility, special facility to give special loans to banks. Problem solved, and they went back to hiking again. So this time what seems to be happening is that they are willing to duct tape any sector in the financial system that cracks just so they can keep on hiking. So it might not be enough for something to break to stop the Fed. I think they're really looking at inflation to come down, and that hasn't been happening so far.
Thanks, Joseph. There's a lot more I'm sure we could say about all this. I want to give Joe Brown a chance to respond, and then I've got another question I want to kind of take us down. And we're going to do some questions as well at the end. So in the audience, if you have some questions, just keep those in mind and get a chance to ask those in a minute. Go ahead, Joe.
Yeah, I'll be brief. The main thing about the interest rates and demand, basically, when interest rates are higher, that incentivizes saving and lending. When interest rates are low, that incentivizes borrowing and spending. And so when interest rates were very low, it started to decrease the value of the dollar globally. And as interest rates are really high right now, that incentivizes the saving and the lending. And so that sucks dollars out of circulation. That's why the money supply is actually dropping right now, because dollars are actually becoming more scarce as a result. And so the longer this keeps up, the sooner you get to a point where, somebody needs dollars and there aren't enough dollars for that. Now, who knows how long that'll take before that happens, but that is what happened. Like you mentioned, Bridger, when in the end of 2018 in December, they were raising interest rates. The government wanted to borrow. There was no more money left in the system for banks to lend to the government. And so they had to reverse course immediately. And the reason why they did is because there was no inflation. So they had no excuse, nothing to point at and say, hey, we can't reverse because X, Y, and Z. It was like, well, there's no reason for us to not reverse. It's not like we have inflation right now. And so they did. So they just cut rates and went back to being easy. But now they can't do that because they have two jobs given them by Congress: stable prices and maximum employment. And so far they've been kind of pushing the employment thing off to the side, although the metrics that they look at show that employment is strong. And they've just been looking at inflation. They're saying, hey, if we can't increase demand for the dollar again, and because that's what high inflation is, it's the inverse of that. If we can't make dollars more scarce, then we're done here. So we need to make dollars more scarce, suck them out of circulation, cause people to save, cause people to lend, no spending, no borrowing, make dollars hard to get, and then that will bring the inflation down.
Thanks, Joe. So I wanted to, some of people, there's a really high level conversation here that is awesome, and you guys are all contributing incredibly to it. I know for a lot of people that are on this, I know a lot of them personally, and we have real estate investors. We've got people that are invested in things like crypto and other stocks and bonds and other things as well. And some people have a fair amount of net worth, saying, hey, how do I not only not lose the net worth that I have, but what is the opportunity that's here, right? Because every change and this is like a board game that changes, like just the rules keep changing, right? So how does somebody take advantage of what's happening right now? What do you see personally kind of as some of the greater opportunities in investing? What sort of asset classes or strategies are you seeing? Maybe we can start with Bridger on this one.
And by the way, it's been great conversation, great discussion. I love it. You guys are smart folks. Okay, not financial legal advice. Everyone disclaimed. I'll just share
all of us
a few things that I'm looking at. Right now, I run a cryptocurrency hedge fund. And so I'll talk about crypto for a second. There's actually a lot of interesting things happening in crypto and kind of two arguments. First one is the SEC's fight against crypto. They've filed against Coinbase and Binance in the last 2 weeks. All three major banks, Silvergate, Silicon Valley Bank, and Signature Bank, were pretty much the three largest crypto banks in the country that all got folded up very quickly by the FDIC. So a lot of people are pointing to this war on crypto against the Fed and or SEC and let's just call it the government. At the same time, last week you see BlackRock, Citadel, Schwab, and Fidelity all announced that they are essentially getting into the crypto game. Additionally, the Fed has launched the Fed Now protocol, or I call it the protocol. It's again, now to be clear, that Fed Now is not a cryptocurrency. It should be coming out in July. We actually have a bunch of friends that maybe these folks have more information, but that work at big banks. Fed Now is actually pretty cool. It's essentially Venmo or Cash App with wires. So instead of waiting for 2 or sometimes over a weekend, 3 days for a wire to go through, you can send instant wires. And what our banking people are telling us, the initial launch is going to be up to $500,000 instantly for wires 24/7, which is pretty cool. Corporations will be up to $5 million. That is the start, and it will go up from there, which is pretty significant change to a more digital. And I think later in the agenda, we're going to talk about central bank digital currencies, that route. So I think at least for me, I tell people, at least for myself, I love real estate, stocks, bonds. I have a piece of my portfolio though dedicated to cryptocurrency, just because I think the opportunity is so massive. If they did launch a central bank digital currency, there's a lot of companies and countries moving towards that direction. It's good to have exposure to that asset class. The last thing I'll say is I'm personally just seeing a lot of opportunities where their war chests are running out in their businesses, and people are needing short-term loans and or asset-backed loans. That's kind of more personal finance space where, hey, you know what? I got a property. If you give me 50 grand, I'll give you a first deed of trust in this property because I need to go save my business. And so you can do private money loans. I've seen a lot of these rise just because debt is so expensive right now and people are trying to float the bills between them. So I'll stop there. There's a lot of opportunities. Those are two that I'm seeing right now.
Yeah. Awesome. Thanks, Bridger. Appreciate that. Let's go to Joe and we'll come back to Joseph.
Yeah, absolutely. I fully agree with the Bitcoin piece of what you were just saying, Bridger. The timing of this is kind of crazy. So we had the attack on Coinbase. Basically, the government's trying to stop Coinbase from doing what it's doing. Sues Binance, and then within weeks, you have EDX, that's the Fidelity, Citadel, and one other backed crypto exchange go live or look to go live. We also have the today actually the BITX, that's a 2x leverage Bitcoin ETF, just got launched. Now it's not a Bitcoin spot ETF, it's a futures ETF, so that's why it was able to get approved. But it's leveraged, so then that happens. And then right at the same time, BlackRock files for Bitcoin spot ETF, which is like there's a trail of corpses of Bitcoin ETFs that have been filed and rejected. So why would BlackRock, the biggest asset manager in the world, now of all times during the crackdown on crypto, file for their own? And the best part is they're going to be using Coinbase as their custodian, which is the target of SEC's charges. So it's like, what do they know? All of that timing seems wrong, so wrong that it's like they must know something. And Coinbase is up like 50% from its bottom, right when the the SEC lawsuit happened. So right now, I'm very bullish on Bitcoin. The next thing is commodities and uranium specifically. So the S&P to commodities ratio is at like it's at like the lowest point that it's kind of like a cycle throughout, last 100 years, the value of the S&P 500 versus commodities. And it's at a low point right now. And it looks like, we're in this beginning stages of a commodities super cycle. Deglobalization contributes to this. The political instability around the world contributes to this as well. So there are a lot of driving factors for this. And then specifically uranium, we are seeing a massive shift over the last, really recently, 2 years. Public sentiment has gone from 50% in favor of nuclear energy to 77% in favor of nuclear energy. Public policy is changing very quickly as well. So Sweden just renounced their 100% green campaign and said, nope, we're advancing nuclear again, where in the past they had said we're going to shut down all nuclear. We see countries all around the world like China, countries who have never cared about, green initiative, that are moving forward with building nuclear power plants. And then the Biden administration even is pouring a ton of money into trying to kickstart new nuclear power plants around the country. And so we're seeing this massive shift right now where I think the public has kind of finally awakened and realized, oh, it's actually the cleanest, the safest, the most energy dense. We've solved all the scary problems that, Homer Simpson has, put into our minds over the last, years of green goo and people turning into frogs and stuff. And so I think there's a big shift, and I'm very bullish on uranium right now. Technically speaking, there's been a 2-3 year consolidation pattern forming, technical analysis on the uranium chart. And so URNM is an ETF. I think that's a mining ETF by Sprott. URA, I think, is an ETF that's just spot ETF on uranium itself. And then finally, just in business in general, right now, I really like companies that have, large moats and are dealing with things that people need, like Maslow's hierarchy of needs. luxuries. When times get tough, when times get hard, people stop, spending on what they want to, but they always keep on spending money on what they need to. There's a reason why Bill Gates has been buying up farmland all across the United States. People always buy food. In fact, in the Weimar Republic during their hyperinflation, the farmers were the ones who, they were actually getting rich. And so people will always continue to buy what they need, even despite how hard times get. And so I like companies that are dealing in those types of spaces right now. And that's one of the reasons why Berkshire Hathaway is doing so well right now versus, many tech companies. And the tech companies that are doing well, like NVIDIA, it's like, look at their PE ratio. Like that's in some severe bubble territory right now. So I like Bitcoin, commodities, uranium, and companies with big moats that deal with, the basic human needs.
Thanks, Joe. We actually had Rick Rule, the billionaire investor, on here talk about uranium. Talks a lot about uranium as well. There's definitely a changing attitude toward that and nuclear energy as well. Joseph, what do you see as the opportunities right now?
So right now, I'm really cautious on the markets. So I look at the markets through the lens of interest rates. And my view is that interest rates are going to be higher than what the market expects. The market over the past year actually has always thought that, soon Fed is going to cut rates. We're going to go back to the old paradigm where we have low inflation, low rates, and, financial assets are going to go to the moon again. And that trade, I think, has been too early. And so I think people have been buying bonds and buying stocks throughout this year, just anticipating the Fed pivot. But I'm thinking the pivot is pretty far away from now. And so when the market finally realizes that, I think they're going to sell off, and it might be a little bit violent. So what I'm thinking is that I'm happy in cash or even short the market now. And maybe, let's say, in a few months, after, let's say, we have a shakeout in the markets, I'd be constructive towards things that are also commodities, especially energy. My view is that over the next 10 years, we're going to have a high inflation. And so by definition, that means stuff costs more. And so that's good for commodities. Commodities it's just basically stuff. So I would like miners. I like, say, energy royalty companies, energy producers, stuff that has good cash flow and that will pay a dividend. So it's really important to me that I look at a company and I can get a return, but from their dividends. Just asset appreciation is not what I'm looking for. So I'm looking for income streams. So that's how I basically think right now.
Yeah, absolutely. Thanks for sharing that. I think for us, personally, I look at things that are cash flowing, right? There's a lot of times real estate, which is kind of what we've been doing for a long time. A lot of the cash flow has been really, it's slowed down a bit. Insurance costs, labor costs, a lot of these things are going up, especially with higher interest costs as well. It's changed valuations as well. So having things like commodities or cash flowing assets that pay you to hold them outside of real estate has been really attractive for us. We're going to start taking some Q&A now. And then I also want to, so if you have a question and you're in the audience there, go ahead and drop that in the Q&A section. You can put it in the chat. We may not get to it quite as quickly, but in the Q&A, we'll get it there. While we're waiting for some questions to come in, I want to ask a question, and this doesn't have to be a super long response. I feel like each of you could talk for like an hour on this topic, but central bank digital currency, is it coming? Is it here? What are the implications of it? Does cash go away? Who wants to give maybe about 1 to 2 minutes on that?
I can hop in. I have something interesting to share, actually. If you can let me share my screen.
Sure. Let me see if I can do that.
I just pulled this up in anticipation of this question, actually. So I thought it would. I think this is pretty interesting. So this is from, if you guys can see my screen, atlanticcouncil.org. They actually track governments that are launching or in development of central bank digital currencies. Now, just to note, the U.S. already completed a test of a central bank digital currency with the New York Fed, Citigroup, and Wells Fargo. This is from last November to I think it was a 12-week test of February. They completed the test. And then about a month later, all these banks started collapsing. This whole move to the Fed now, anyways, just happened after that. If you scroll down here, this actually tracks all the countries that are in this. So right here, 11 countries have already actually launched a central bank digital currency. I believe, well, China's should be launched as well. I'm not sure why they're not on here. Pilot programs is 18. Oh, I guess they would count China as a pilot program. So China is kind of the most major one that's in a pilot program. In development is actually United States, and 32 countries are currently in development of this right now. and then 40 total are in research, which is pretty interesting. The CHIPS Act last year, my business partner is actually on the board of Intel. He served on the board of Intel for 15 years. Intel, the CHIPS Act was I believe $54 billion got passed to develop infrastructure, develop chips and manufacturing plants and fab facilities in the United States. There's another 280 billion that can be unlocked this next year to develop this kind of stuff. And Intel is a huge player. They're developing it right now in Ohio, a huge place in Phoenix. And at least my business partner, Dan, is saying, he's like, man, they're overdeveloping right now. He goes, he thinks they are potentially developing the infrastructure, their own data centers that they would need to house a central bank digital currency. Sorry, this is supposed to be a short answer, so I'll cut it off there if you want me to cut it off. But I believe if our dollar's dead, I think they would just transition. It would just become the on-ramp. It'd be pretty much all of our money's already digital, pretty much. Like we have bank accounts, credit cards, everything's already kind of digital. It wouldn't be that big of a shift. It would be it'd just be the on-ramp to crypto. I don't think it would kill crypto. I think it would just be the on-ramp to crypto. And they would use wallets. And I believe it's just too juicy of a thing not to do as a central bank. It's too much data. It's just so juicy not to do. I'll end there. I could talk for an hour on this, but I'll stop there.
Yeah, no, I want to give a thought real quick here too, and I'm going to pass it to Joe and Joseph. So we actually do a lot with ATM machines. We've raised $12 million for ATM machines. There's actually 4.5% of households don't even have a bank account, and there's a lot of people that operate in cash. So as much as we're going digital, the whole thought of going completely digital and no more cash, that's a different situation. That some CBDC is available, but then if you do away with cash, I guess that's a whole nother question, right? Because then you have privacy issues where the Fed can track every single transaction you're doing. It changes the financial system as a whole, maybe, does away with a lot of banks and things like that. They control all of that. And then on the left, for politically, they would say, well, who would this hurt, right? It would hurt people that have cash businesses or low income, or people that are getting unemployment or things like this. So there's some issues there. So I know central bank digital currency, it's coming, it's here. It'd be interesting to know your thoughts as well, Joe and Joseph, like what does that do to cash? And does that persist, or how does that change? Anyway, any of that you want to tackle, or what Bridger said, or just even your own thoughts? Let's start with Joseph on this one.
Yeah, so I totally agree. I think central bank digital currencies are coming. They will definitely come. I think it's going to be a bit slower in the US. I think other countries, like let's say the Eurozone, Canada, Bank of England, I think they'll be a bit faster. So Bronson, I think your concerns about privacy are totally legitimate. So at the end of the day, I mean, having a CBDC gives the government a lot of control over what we can buy and what we can't buy. And sometimes that power can be abused. Now, we don't have to go too far back in history to see how that could be the case. Remember last year, or was it 2 years ago, there was a big protest in Canada where a lot of truckers were unhappy with vaccine mandates. So they were protesting peacefully. And that made the government mad. So the government's like, we want to seize your bank accounts. Now, that's actually kind of hard to do because, you have to go through court, and you have to go through private businesses and make them comply. But if you have a CBDC, it's really easy to do. And you could see a world where, you hold the wrong beliefs, maybe you vote for the wrong person, and maybe you don't have a bank account. So there's a real legitimate threat there. Now, the thing is, this concern is actually, I think, more influential in the US than it is in other countries. So in the US, now the decision to make a CBDC is ultimately a political decision. At the Fed, there were people who were like all about the CBDCs, and Lil Brainerd, for example, who is now part of the Biden administration, was a proponent of CBDCs. Chair Powell, though, realizes that this is a very contentious issue, and his view right now is that we're not going to do a CBDC unless we get specific authorization from Congress. So you got all these reserve banks doing some experiments, maybe getting ready in case we have to do this. But at least as long as Powell is chair, he's going to defer to Congress to get for the ultimate say. But I suspect eventually we'll get there, since that seems to be the trend. I actually find this pretty worrying. Now, Bronson, to your point about, there are people who want to operate in cash markets. What are they going to do? So privacy issues and so forth. So I hope we don't go to a CBDC, but it looks like that's the trend so far.
All right, thanks, Joseph. Joe.
Yeah, I give this analogy like if we saw everybody just leaving, expatriating from the countries and going to live on boats in the middle of the ocean so that they could be free and just live on their own, governments would look at that and say, hey, well, people are leaving because they want to live on boats, so let's make our own boat, and it's still just part of the nation. It's like, no, you missed the whole point. It's people are trying to escape the country. It's like a lot of people want to use Bitcoin or crypto or a lot of times even cash because they want to be free from the censorship, the visibility. They want to get out of government money, that type of thing. And it's like a CBDC like doesn't solve why people have been looking to crypto, in the past. It's just more, it's more of what people are trying to escape. But there are some good reasons why the government would be able to, from a visibility perspective and say, hey, like these are the good things we'll be able to do with the CBDC. They'll be able to like with Fed now, it's like you increase the speed of transactions. You can implement, this would be a much more melding of the Fed and the Treasury. You can implement fiscal policy and monetary policy under one house. And so, you can streamline taxation, do away with the IRS. You can automate a lot of this. You can implement, stimulus checks, immediately without having to send checks out. You can do things like in real time. Hey, we're seeing gas prices take off, and it's because people are hoarding gas. So you have to, only $400 a month you can spend on gas. And we're instituting a ration in real time until the problem goes away. So you have all these little controls that follow the trend of the Fed used to strictly do large sledgehammer approaches of interest rates and then quantitative easing, and now slowly moving in towards very specific bailout of, hey, just the depositors at just this bank, and we're not going to make a guarantee of that same thing for any other banks. And so more of a scalpel-like approach, and a central bank digital currency allows that on every single little avenue. You can fine-tune the entire economy because money is one half of every transaction. So if you can entirely control the money, you can entirely control the flow of resources in the economy. And that's why I think it's, in my opinion, like the fear aspect is just the amount of control. Not that they necessarily would use it for that, but the ability to use it in that way would always be there. Like the Patriot Act, in theory, could have been a fantastic way to catch terrorists, but for the most part, it wasn't really used for that. And it's been used to spy on every single American for the last 25 years. And so we know what they do when they've been given power. And so this is kind of the next step. But there's also, when you look at this from like, what's really happening on a, foundation level, it's a nationalization of banking in the United States because it renders banks useless. And it really does seem like then that will be the next step, because you have this process of, hey, we have regulations to stop, banks from making excess profits during these times of taking excess risks. And then they have to find other ways to make money. And then that causes some, risk and some blow up. And then we have to subsidize to bail out. And all the bankers who got rich got the bailout. And you have this like back and forth, eventually get to the point where banks just can't operate anymore. They're not private businesses anymore. And they're not able to do the things like they used to be able to do. And so having some sort of a nationalization, banks become the infrastructure for central bank digital currency, one unified ledger for all transactions. It just kind of makes sense in terms of the direction that we're going here. And then you eliminate the need for banks to be these private businesses. It's all nationalized. You centralize banking and fiscal policy and monetary policy all under one roof. And I think there is a fear factor there. But if there's some sort of a catalyst that's big enough, people will be willing to move to that, because the alternative might be Great Depression.
Yeah, no, there's a lot of factors. We could spend probably hours just on this one topic, but I really appreciate it. We didn't get a chance to get to AI and the financial system, and I'll love to have you guys back for another panel. So this has been phenomenal. I want to be sensitive of everybody's time. I know, this has been awesome. And I know we have folks that are fans of all these guys. So wanted to give each of you a chance to, if people want to follow you and hear about what you're doing, how can people follow you and get in touch with you and follow your channels and all that stuff? Let's start with Bridger, because I know you got a time sensitive thing here.
Well, I'll say this, Bronson, it's been phenomenal. Thanks for putting this on. What a cool group. And I wish we had more time. And Joe and Joseph, good to hang out with y'all. You guys are sharp people. So for me, I run a YouTube channel. So Bridger Pennington's my name. We teach primarily about how to launch funds. So if you want to launch a investment fund, private equity, hedge fund, venture capital, real estate fund, we launched 130 funds last year. We have 12 student funds over $100 million now in our group. So, and I'll give a gift away if it's okay to this whole group.
Yeah.
If you guys want, we have a free course on funds, 100% free. It's like 15 plus videos. There's downloadable PDFs, guides. Our goal is to just help more people understand the game of funds, like how they're built, how they're put together. So if you guys want that, and just full transparency, it's just, it's fundlaunch.com. You can go there. All you do is put your email in and you're subscribed to the list or whatever. If I send over, we do updates and live calls, just full transparency. That's kind of what it is. But at the same time, you get a full free course that's there, and it's awesome. And our goal is just to educate more people to launch and scale investment funds. So fundlaunch.com, and then my name's just Bridger Pennington. You can go find me on Instagram or send me a DM on Instagram. If you can't find it, I'll message you back with the course. So there you go. Thank you guys again for having me. This has been phenomenal.
It's been great. Thanks so much, Bridger. Appreciate it. All right, Joseph, how can people follow you and get in touch with you?
Well, first of all, thanks so much for having me. It's a pleasure to meet Bridger and to see Joe again and to be on the show, Bronson. So I teach and write about the markets. If you are interested in my work, again, you can check out my book, Central Banking 101, on Amazon, one of the best-selling books on macroeconomics. You can also, and of course, if you are interested in learning more, I have a website, fedguy.com, where I write about the markets, and I also have online courses and things like that. Also YouTube channel and Twitter and all that stuff, but you can find all of that on fedguy.com. Yeah, check it out.
Awesome. Thanks so much, Joseph. Joe.
Yeah, thanks again for having me. This was fun. The main place that I put content up is going to be my YouTube channel. It's at Heresy Financial. Heresy is an old religious word that means an opinion profoundly at odds with what's generally accepted. And then that is my handle everywhere else as well. So if you're on Twitter, I'm active on Twitter, social media, everywhere. And so the podcast as well. So if you're looking for free content, macro, investment related, how money works, find me anywhere at Heresy Financial.
Awesome. Thanks, Joe. We will have this event again next month. It's going to be a multifamily event, or actually a real estate roundtable with a couple guests, Bob Frazier from Aspen Funds. We have Ryan Gibson, who has a large self-storage group. We're working on one other guest as well. We also have a live in-person event with Ken McElroy, Neil Bawa, and this is going to be in Los Angeles, October 19th and 20th. I just put it in the chat there. It's called the Advanced Real Estate Investing Summit. We just launched it, and so it just went live. For this 20% off, you can use this code SUMMIT20, and the first 50 people that sign up get a copy of my new book called Fire Yourself: Replace Your Working Income with Passive Income in 3 years or less. It's not even out yet, as well as my partner, Stephanie Boldrini, will get a copy of each of our books. So check that out there. Really appreciate each of you for being here. Tremendous respect for each of you guys and the value you're adding to the space in all sorts of ways. So thanks so much, everybody, for being here. Thanks to our audience as well. Look forward to seeing everybody on the next panel. Thanks so much.